Hello and welcome to this special discussion on the impact of the IL&FS Group's default on financial markets and the banking system. I am Latha Venkatesh. Well, in August this year, this infrastructure financier, IL&FS, with a 93,000 crore exposure to financial markets and banks, defaulted on one of its commercial paper, and this month it defaulted on its intercorporate deposit. Rating agency ICRA downgraded some of the loans of the IL&FS Group from AA+ in August to D, all in a space of 2 weeks. Probably because of this, risk aversion crept into the debt market, and on Wednesday, one fund, DSP, sold its investment in DHFL's debentures at an 11% yield, a little above what the market was willing to say is a usual level for that paper. This news led to fears that NBFCs generally could find it difficult to get funding and roll over their CPs. Their stocks fell sharply. Over the next half hour, we are going to take a closer look at whether and how the IL&FS issue could lead to greater problems in the debt markets and the NBFC sectors. Joining us are Amandeep Chopra, Group President and Head of Fixed Income at UTI Mutual Fund, Shrikant Vadlamani, the Vice President, Financial Institutions Group at Moody's Investors Services, and Lakshmi Iyer, the Chief Investment Officer, Debt and Head Product of Kotak Asset Management Company. Gentlemen and lady, welcome to the show. First up, Amandeep, am I connecting the right dots? The IL&FS event default to the sale of DHFL at well above market yields.
So, Latha, I guess, there is some degree of, relationship over there. I think DSP has come on your channel to say that the IL&FS default and the markdown that they had to undertake did create a bit of, redemption pressure, which they had to meet by generating liquidity, which also then culminated in, having to sell other securities within the portfolio. Now, we do understand that the bond markets are relatively tighter than, what they were a couple of months ago. This has clearly been driven partly by, the tightening that we've seen from the central bank, and also a degree of risk aversion as far as, new investments are concerned. So I think in that backdrop, one would expect the spreads to widen, and maybe when you do need liquidity in a very quick manner and you have to sell an asset, you actually, are entering the buyer's market. And I think that is a backdrop where possibly, you could have seen selling at levels which would be much higher than what ordinarily, a typical bond like this would have.
Ordinarily, what would it have gone for?
I think ordinarily one would have expected the bond to yield trade somewhere between 10 quarter.
Okay. All right. So that's the markup that of yield that you the fund had to give. Lakshmi, let me come to you on a similar issue. At the heyday of mutual funds and NBFCs, that is all through 2017, a lot of mutual funds launched that Credit Opportunities Fund, which they very clearly said was a high-yield kind of fund, though it was a fixed income fund. And SEBI actually even asked these funds to change the name from Credit Opportunity to Credit Risk. Now, do you think that there could be a problem in this fund, that a lot of people may have invested and they want redemptions, and therefore these funds are forced to sell?
So, Latha, the beauty of the situation that we are witnessing today, whether it was a month back as you introduced just at the beginning of the show for IL&FS, or it is for Divan, or some of the other NBFCs where the market caps have got eroded in the equity market, specifically those in the listed space. Interestingly, if you map the ratings of their debenture outstanding, it's actually AAA. So we are really not talking about these entities actually qualifying as a credit, risk category. But of course, you may have those as an investment, universe. So the point I'm trying to make is that in this kind of a market, when the liquidity genuinely is tight because of advanced tax outflow, and it gets compounded by a situation like this, why would even a liquid fund be spared? So I don't think credit risk fund also would be an exception. The only saving grace is that you need to make these investments for a minimum of 3 years if you want to avail of long-term capital gains tax. So therefore, and then the second reason that bulk of this money in the industry is retail and sticky money, the tendency of outflow may not be as fast as could it be for some of the liquid and ultra short-term category funds. But clearly this is not a credit scare which is leading to a panic, but more of a liquidity-driven selling pressure which is accentuating the panic in the market.
Yeah, a liquidity scare can become a solvency issue if it is not attended to. And we have seen that play out in debt markets over and over again. Shrikant Vadlamani, before I come to that, whether, a liquidity scare can become a solvency issue, I want to ask you whether this IL&FS downgrade is not just only one. That may be something that is playing on the market's mind, that something which was actually AA+ was not really AA+. The yield indicated that. Although IL&FS was, rated as AA, even in August and before that, it was not trading at a yield of under 10. It was yielding higher. So the market's fear is maybe there are other high-rated paper which don't deserve to be. Is that a legitimate fear?
Sure. I think that's a very good question, because that's probably an indicator of how sustainable or how permanent the issues that have surfaced out in the last 2 days are. And I think the answer reassuringly is no. I mean, if you look at the broader finance company sector in India, we're talking about players predominant in retail. I mean, the ones that have been prominent in the last 2 days are in mortgage finance. And the contrast between what's happening in infrastructure financing, which is where IL&FS is, and what's happening in terms of the broader retail market can't be starker.
Yes.
So, in fact, this has been the best performing segment as far as the credit metrics are concerned.
Okay.
Of course, we do have concerns that there is some froth building up in retail, but that's more of a cyclical correction. So, when we look at the broader solvency metrics, clearly, I don't think there should be any cause of concern on the retail financiers.
Okay. Well, actually, I think that's a very clarion statement that you're making, that problems of IL&FS, which are a huge asset liability mismatch because they lend to infrastructure, cannot be compared to, companies like DHFL or Indiabulls, who are largely retail financiers, and therefore the market is probably unnecessarily scared. Would you agree, Amandeep?
So, Latha, if you remember in one of your earlier programs, I had mentioned that the financial conditions today are much tighter. So a typical AAA NBFC today is borrowing at almost 120 basis points higher than where we were, beginning of this year, and about 180 basis points over, same time last year. So I think some of that is bound to spill over into two things. One is a gradual, slowdown as far as incremental growth is concerned. Because, a lot of growth that we've seen of late is retail/consumption driven, demand. So that clearly is impacted by higher cost of, borrowing.
Yeah.
And secondly, I guess even in terms of, the margins and ability to grow the balance sheet at the same size as you were doing 12 months ago is going to be impacted. So I think a lot of that is now going to be seen in the way, you will have some of these entities going forward. But again, you were talking earlier about the stock market reaction.
Yeah.
Like I mentioned, year to date, you've seen cost of funding go by 120 basis points. I don't think the stocks really factored that in.
Yep.
So clearly there was some element of realization that, it is going to become a little bit more difficult to sustain the same level of growth when you have such higher cost of funding, and also it's going to sort of, maybe, lead to some bit of compression as far as your margins are concerned going ahead. And I think that realization possibly could have reflected.
I'll have to take a mandatory break. I'm coming back and posing that question to our debt market experts. How much more reverberations can the IL&FS debentures bring to the debt market. In a minute with my experts.